In the realm of investing, the quest for strategies that enhance returns without proportionately increasing risk is perpetual. One such strategy involves the use of LEAPs, long-term equity anticipation securities, options, specifically focusing on selling options rather than buying them. This approach is predicated on the concept that the house always wins, drawing a parallel with casinos where the odds are structured to favor the house over the long term. Similarly, in the options market, statistics show that a significant majority of options expire worthless, suggesting that sellers of options tend to have an advantage over buyers. Why sell LEAPS options? Selling LEAPS options can be a strategic way to generate additional income from your investment portfolio. LEAPs are options that are available with expiration dates longer than 1 year, providing more time for your investment strategy to play out. The inherent time value in these long-dated options can be lucrative for sellers, as it provides a premium that is generally higher than that found in shorter-term options. Also, some of the long-term options are mispriced, and once you have learned how to use them, then you can take this mispricing to your advantage. Covered call strategy. One common method of selling options to enhance returns is the covered call strategy. This involves holding a long position in a stock while simultaneously selling a call option on the same stock. The idea is to earn extra income from the option premium, which the investor gets to keep regardless of whether the option is exercised. If the stock price remains below the strike price of the option until expiration, the option expires worthless, and the investor retains both the stock and the premium. Even if the stock price rises above the strike price and the option is exercised, the investor benefits from the stock's appreciation up to the strike price, plus the premium received. Selling puts for entry. Another strategy involves selling put options as a method of potentially buying a stock at a lower price. When you sell a put, you collect a premium upfront and obligate yourself to buy the stock at the strike price if the option is exercised. This strategy can be particularly appealing if you're looking to purchase the stock at a price below its current market value. If the stock price stays above the strike price, the put option expires worthless, and you keep the premium, effectively lowering the cost basis of your entry if you choose to buy the stock later. Enhancing stock purchases with option sales. Incorporating option sales when buying stocks can be a more effective strategy than purchasing stocks outright. By selling an option, you receive a premium that provides immediate returns. If the stock price moves against you, this premium can offer a buffer against the loss. Over time, these premiums can accumulate, significantly enhancing your overall investment returns. In conclusion, selling LEAPS options can be a powerful strategy to increase investment returns, leveraging the statistical advantage that most options expire worthless. Whether through covered calls or selling puts, the key is to use these strategies judiciously, aligning them with your investment goals and risk tolerance. Remember, while selling options can offer additional income and strategic entry points, it's essential to understand the obligations and risks associated with these positions fully. As always, it's prudent to conduct thorough research or consult with a financial advisor to tailor these strategies to your specific financial situation. We are going to illustrate this with an example. It is important to remember that this is not an investment advice and the options prices shown are just to illustrate the point. It is very important to choose the right stock for this strategy. Using this strategy indiscriminately to any stock that you think will go up will only lead to losses. The stocks chosen should be good quality stocks which you have done proper analysis on. You should be happy to hold it for the long term even if the share price goes against you in the short term. Ideally, the strategy is suited for dividend stocks, as this strategy will enhance their dividend income. We are going to use Rio Tinto as an example. This is the research that we have done on Rio Tinto stock. Rio Tinto, a leading global mining group, is a significant player in the extraction and processing of a range of essential materials, including iron ore, copper, aluminum, and, more recently, lithium. We are going to look at Rio Tinto's financial health, operational strengths, and future prospects, particularly focusing on its pivotal role in the commodities market. Financial overview. As of the current analysis, Rio Tinto is trading at a market price of $63, with a P/E ratio of 10.21, signaling a potentially attractive valuation compared to industry peers. The company boasts a substantial market capitalization of $104 billion and maintains a relatively low debt level at $4 billion, indicating a robust financial structure. A notable dividend yield of 6.8% makes it an appealing choice for income-focused investors. Furthermore, an ROE of about 18% reflects efficient capital utilization and profitability. Core business segments. Iron ore. Iron ore is a cornerstone of Rio Tinto's business, with the commodity being integral to global steel production. The growing population and accelerating economic growth in Asia and Africa bode well for iron ore demand, as infrastructure development and urbanization drive steel consumption. Rio Tinto's high-margin iron ore business benefits from economies of scale and operational efficiency, positioning it well to capitalize on this demand surge. Their EBITDA margins were 69% for iron ore last year. Copper. The Oyu Tolgoi mine in Mongolia is set to become one of the world's largest copper mines upon full operation. Besides copper, the mine is expected to produce gold as a byproduct, adding a lucrative secondary income stream. Copper's role in green technologies, such as electric vehicles and renewable energy systems, underscores its growing importance. As global initiatives towards sustainable development intensify, the demand for copper is anticipated to rise, aligning with Rio Tinto's strategic expansion in this sector. Rio Tinto expects about $4 billion in revenue when the mine becomes fully operational in 2028. Aluminum. Rio Tinto's aluminum business contributes significantly to its diversified portfolio, supplying a metal crucial for various industries, including automotive, construction, and packaging. The company's commitment to sustainability is evident in its efforts to reduce the carbon footprint of its aluminum production processes. This currently only contributes to a small portion of their revenue. Lithium. Venturing into lithium mining, Rio Tinto is positioning itself in the burgeoning battery materials market, critical for the electric vehicle and energy storage sectors. This expansion reflects the company's adaptive strategy in response to evolving global energy trends. They have early-stage lithium projects in Argentina and Serbia. Strategic developments. Simandou Project. The Simandou mine in Guinea, one of the largest undeveloped high-grade iron ore deposits globally, is a significant asset in Rio Tinto's portfolio. Its development could substantially enhance the company's iron ore supply, though it comes with geopolitical and logistical challenges. High-grade iron ore is likely to replace lower-grade ore as the preferred raw material for manufacturing steel, as less energy is needed to purify the ore. Copper and green technology. The increasing incorporation of copper in green technologies, due to its essential role in electrical equipment, positions Rio Tinto advantageously as the demand for sustainable and efficient energy solutions escalates. Conclusion. Rio Tinto's strategic positioning in iron ore, copper, aluminum, and lithium mining, coupled with its robust financials, positions it as a compelling entity in the mining sector. The company's engagement in high-growth areas like green technology and its expansion into critical minerals like lithium align with global economic and environmental trends. While operational and geopolitical risks persist, particularly in new ventures like the Simandou mine, Rio Tinto's diversified portfolio, strong financial foundation, and strategic foresight underscore its potential for sustained growth and resilience in the dynamic global commodities market. The risks to this analysis happens if the global economy goes into severe recession, which will reduce the prices of commodities that Rio Tinto sells. However, the risks are short-term, and because of their financial position and premium high-value mines, they have a good chance of weathering a severe recession. The following slides show the options chain for Rio Tinto January 2026. Option prices are higher during times of market volatility. So the investor is advised to wait for market volatility to get better prices. The strategy is to buy 100 shares of Rio Tinto and at the same time sell the January 2026 $70 call. By selling this call, the investor collects the $6.71 premium. The investor then sells the January 2026 $50 put and collects the $3.91 premium. The idea here is to collect the dividends and while he waits for the options to expire worthless. Since he has sold the options, he gets to keep both the dividends and the premium collected. He can then repeat the same by selling more calls and puts. This can significantly enhance the returns over the long term. For the sake of simplicity, we only look at 2 further scenarios. Scenario 1. Rio Tinto share price is above $70. Your shares can potentially be called away. The $50 put will expire worthless. Scenario 2. Rio Tinto share price is below $50. Here the investor is obligated to buy 100 more shares of Rio Tinto. As the investor had already done his research and is confident of the long-term fundamentals of Rio Tinto, he is more than happy to buy the stock at $50. He now has 200 shares. He can now sell more calls and puts to enhance his returns. Using this strategy, the investor can enhance his returns by up to 10%, and even more depending on the scenario. This, when compounded over time, will result in significantly higher returns than by buying shares alone. We hope you liked this video, and if you liked it, please like and subscribe.